Hi, Professor Park. Good seeing you.
Hey, Enya, good to see you.
Has been a while.
It's going well. How about you?
Doing really well. Thank you. Thank you for
looking forward to today's the presentation.
Wonderful. I think let's get started. Given the time being very short, we have an hour in total. My name is Enya. I'm part of the Lloyds US team. I'm based in Texas, here in the South region. We also have my colleague, Pat Talley and Rodney Smith join us today. So the three of us will give you a very quick overview of Lloyds, probably in the first 10, 15 minutes. And then we'll have hopefully special guest Ian join us around a half an hour time. And he is part of Dale Underwriting, which is part of Lloyd's market. And he will share with all of us the perspective as a Lloyd's underwriter and how the market really works from his perspective. So without further ado, let's move on to the first slides, Mark.
And actually, don't mean to interrupt, but would you mention about the recording, please, Enya?
Oh, yes. So today's session will be on recording. I'll be published on Lloyd's YouTube channel. So if anyone have any issues with being recorded, please let us know and we can disconnect you right now if that's an issue for you. Again, welcome everyone. We have faculty, we have college students join us today. We thank you for making the time to join us for this special session at RIMS for all the college program. And every year, this is the highlight of our RIMS experience, is to really engage the college students who are interested in insurance and risk management as a career path. As some of you guys been teaching for years, you know this is a great career, a lot of fun, a lot of different choices in this profession. And all of us, we just love to be in this profession. We love to share with you what Lloyds is and how to access Lloyds, give you some ideas on Lloyds. We want to make this session a very interactive session. As a result, we hope you can mute right now when we were speaking, but then once we pass on to the Q&A stage, we would love for you to speak up and have your mic on and become interactive with all of us. So what is Lloyds? Lloyds, as you guys may know, is the only insurance marketplace. So Lloyds is not just a company. Lloyds is a platform consists of multiple parties, including Lloyds Syndicate and Lloyds brokers. And also we work with US and other brokers around the globe. So Lloyds is truly a broker's market. And this is where we all work together to partnership with each other and to share the risk together as a platform. Next slide, Mark. As you can see, Lloyds consists of quite a number of parties. Three of us, Pat, Rodney, and Mark, also my colleague who is doing the show today, who is also our biggest hero, running all those Lloyds shows on the background. So four of us, we all work for the Lloyds Corporation. So this is the platform supporting the Lloyds market. And as far as the market is concerned, the market itself consists of 48 managing agents. When we say managing agent, you're talking about the names of, Beasley, Hiscox, Ascot, all these names. These are so-called managing agent, and they may manage multiple syndicates. For example, Beasley managed 2 or 3 syndicates. So is some other companies. They, under their leadership, they lead 2 or 3 syndicates. So Lloyd's market is a collection of syndicates who are insurance carriers who write the risk, insurance and reinsurance directly. We also have the new concept called syndicate in a box. These are fast track syndicate model that we bring in the capital, give them a quick fail, succeed in a period of 2 to 3 years, and they make it, they can become part of Lloyds. But they're a different model called syndicate in the box. We also have some special purpose arrangements. It could be a runoff. It could be, for a special risk, or could be write a quota share of a business from another syndicate just on a year by year account basis. So just as the center of Lloyd's syndicate, we also, as I mentioned, work with multiple brokers. These include over 200 Lloyd's brokers, majority of which based in London. We also work with service companies such as a branch of Hiscox or Beasley, who are based in the US. And Rodney is going to mention and give you some idea on the so-called cover holders. We have over 4,000 of those so-called cover holders, also work with Lloyd's. And on the other end of the spectrum, you have risk managers, you have individuals. So we insure both corporations and individuals. Tanya, you mentioned you're in Woodland. So we have a group of clients who are based in different parts of the country. Could be high net worth clients, could be, say, some apartment complex clients. We also insure all those big corporations to work with risk managers as well. And on the other end, we have members of Lloyd's. These are the providers of capital. These are the funding source of Lloyd's. And these all together consist of Lloyd's as a marketplace. So with that, I'll pass on to my colleague, Pat, who's going to give you more information on Lloyd's market. Pat, the floor is yours.
Thanks, Enya. Thanks very much. Yes, I've been with Lloyd since 2006, and which is just a tiny slice of the time that Lloyd's has been in existence. I think, as many of you are aware, Lloyd's has been around for like 330 years, I think, and it basically, as a marketplace, it functions largely today as it did when it was first founded, the way that Enya described, where individuals gather together and syndicate or share a risk, and that basic fundamental property exists today. But what's important, I think I should point out, is that Lloyd's is first and foremost is a specialist market. So, what is a specialist market? It typically, even though it writes a lot of garden variety type risks, it also specializes and is an innovator of specialty risks. So not just any standard carrier will write, celebrity body parts or, wind farms or these large complex risks. But Lloyd's is very proud to have a history of firsts, being an innovator and being able to understand emerging risks and be the first to develop commercial solutions to them. So this is just this is an excellent example of the things where Lloyd's was an innovator and first to market. First motor policy written in 1904, which, because of its marine history, I think an interesting piece of trivia is that some of the original policy wordings for motor or auto policies actually referred to a automobile as a ship navigating on land. So they were actually taking, some of the existing wording and just modifying it, trying to make it fit what this new and emerging risk was. First aviation policy, 1911. Again, we're going way back before many companies were even formed. First D&O policies in the 1930s. Satellite launches. I think it was Intelsat was launched in the 1960s. That's it doesn't last very long, but it's a very risky venture. So Lloyd's is known to take on those kinds of risks. Political risk policies were being developed in the 1970s to deal with some of the unrest around the globe, which we see continuing today. Lloyd's was an innovator there. And then, of course, cyber, which you can't open up your tablet without reading about some sort of issue with cyber these days. And Lloyd's was an innovator there. Moving forward, Lloyd's is also a leader in what we call autonomous vehicles and drones, and driverless cars, and those types of things. And also on the cutting edge of all the opportunity built into the sharing economy as it reemerges from our COVID past a year here. So that's important to think about, because when Lloyd's continues today to scan the horizon for emerging risks, trying to figure out what will be the next D&O type, what will be the next asbestos, what will be the next cyber. So because the first person who can understand those risks, as I said, is the first who can commercially capitalize on those and build solutions to them. So I want to talk just real quick about, as you know, Lloyd's is because it's a specialty market, it writes almost exclusively on a surplus lines basis in the US. So I know you've probably learned from your classes that when the standard or admitted market will not or cannot write a risk, which the types of risk Lloyd's traffics in, a lot of those the standard market won't write. So we will export that to Lloyd's and it writes it on a non-admitted basis. I think, and Rod can correct me on this, I think Lloyd's in 2019 wrote about $12 billion in surplus lines business, another 5 or 6 billion in reinsurance, and only a tiny fraction of licensed or admitted business, which is what we think of when we hear State Farm or Allstate and companies like that. So why does Lloyd's write on this basis? Well, because as a specialist market, these types of strange, difficult risks lend themselves to that market because you can custom tailor your policy wordings. You have freedom of rate and form. So it just fits better for Lloyd's as a specialist market. I mean, you can't write Troy Polamalu's hair on standard filed wording. So that helps explain that. Mark, you want to jump to the next slide? So I guess, continuing on that thread of surplus lines versus admitted or licensed business. And this is, if you take nothing else away from today's discussion, this is one of the key things you need to keep in mind as you go into the industry and perhaps work, hopefully, for Lloyd's or one of the market participants. While a standard licensed policy in the United States has a security behind it, a guarantee fund at the state level, people always sometimes wonder, well, is surplus lines a safe place to be? You get a stamp on your policy saying there's no guarantee fund available here. But we need to unpack that a little bit, because state guarantee funds are typically very limited in the amount of coverage they will provide. It might be limited at $100,000 or perhaps less, irrespective of the size of your policy, or you might be too financially large to even participate in the guarantee fund. So there's some caveats there to keep in mind. But what Lloyd's has, and what is very compelling proposition on their behalf, is that Lloyd's has a system, an internal, if you will, chain of security or guarantee fund that ensures that all claims, all valid claims are paid, just as they have been for over 3 centuries. And real quickly, what we refer to as the chain of security gives you, this is an example of how that's provided for. There are 3 links in this chain. The first link, as you see on your screen, it says $70 billion. Those are syndicate level assets. So what that means is that every syndicate, assuming risks at Lloyd's, puts those premiums into a working trust fund, and that's the vehicle from which claims are first paid. That's the first port of call for claims payments. So you have all those assets that are going in there, and they can only be spent from the managing agent, the syndicate that puts them in there. So they are not mutual assets, but that is a significant amount that's there for the payment of claims. So if those are exhausted, the second link in the chain, as you see to the right, called members funds at Lloyd's, which I think these are 2019 figures, was about $36 billion. And you can kind of think of that as somewhat analogous or as a proxy to capital and surplus that you would see on a traditional carrier's financial statement. So that takes all of Lloyd's syndicate plans are very carefully monitored, and they are assessed a charge. How much capital is needed annually to support that risk profile that they're going to write. And then there are a series of other formulas that build in there to uplift that, to add an additional haircut or margin. So somewhat similar to the risk-based capital methodology you may have heard of, but it's a way to say, if you're going to write this type of risk, how much capital needs to be behind that to prudently support that risk? So those assets, again, are only the property of the syndicates who put them into that trust, but here we're already at $100 billion in assets that are there to satisfy the claims as they come due in the course of business. Then this is the real magical part, and that's the third link in the chain, and that's called the central fund. And as you see, it's north of that now, but it's $4 billion in assets that are mutual assets, meaning that subject to the instruction of the council at Lloyd's, if any syndicate, there's something catastrophic happens and they blow themselves up or whatever the term you want to use, those assets sit there and can be petitioned for use to satisfy any and all claims of all underwriters. So when you think about that, I mean, that's $4,000 million to put it in my country term there, of money that sits there available for the payment of claims. That's a very compelling proposition when you think about what's there to cover my claim. And then back to our concern about limits on state guarantee funds. Well, subject to the amount of the assets in the central fund, your limit is your policy limits. So that's, again, that's a very, very strong proposition from a solvency and confidence standpoint on Lloyd's behalf. And what does that get us? It gets the ratings we see at the bottom left of your screen. A AA- by Fitch, which is considered, quote, very strong, an A+ S&P, and then the gold standard in the insurance industry is AM Best, where we are an A or excellent rating. So that's one thing is to keep in mind, because if you go in this industry and you work on the commercial side, and say you're a broker or underwriter, you're going to run up against all these concepts of surplus lines and admitted. And it's important that you know how Lloyd's distinguishes itself from others. Next slide, Mark. Thank you. Okay, we're going to just talk a little bit about Lloyd's financial performance. And this is a slide that gives you the financial performance for the last 6 years. And since I guess all of you on this call are students, I'm going to test your knowledge just a little bit. We look at the top line, it's giving us gross written premium, which is pretty much self-explanatory, the amount of business that Lloyd's wrote globally. So as you can see, from 2016 through 2020, there was a nice up, largely, and there are isolated examples of against it, but it's generally a trend upward. So Lloyd's has typically enjoyed significant premium growth year over year. So I want to ask you a question. So is that a good thing? Does anyone want to pipe in? Is it good to have top line growth in a business? Bueller, any takers here? I guess it's, if you don't come off mute, but what we're thinking is you typically learn in any other industry that, we always want to make more money, right? Well, it's important to remember that in this industry, this is probably one industry, there may be others, but I'm not aware of them, where you don't necessarily want to drive premium or revenue growth, because as you're familiar with from your classes, the market typically ebbs and flows through soft and hard cycles. So when a market is hard and things are getting more expensive, you may want to, your premiums may drive up naturally, but when things are softer and people are chasing rate, you really want to just remember the key principle in this industry is to underwrite profitably, regardless of whether or not you're bringing in more money or not, because that's the key. If you can underwrite in a soft market, underwrite in a hard market, one is much easier than the other, but you want to underwrite profitably all along the line. So don't ever look at this like a GE or a Subway or a Boeing or something like that, where they're always driving top line growth. Okay, let's go to the second line, which is the combined ratio. Anybody want to jump out there? And you better know this, or your professors are going to be mad. What is a combined ratio? I know Rodney's got it written on the back of his hand. Well, think of it very simply. A combined ratio is saying, so, okay, for every dollar of premium that we brought in and earned, what is the combined cost of the claims we paid, and then the administrative costs of running this insurance operation? So if you look in 2016, great, 97.9. That means that for every dollar we brought in, 98 cents of that went out for claims and administrative costs. We had 2 cents left over. So you multiply that by billions, you're doing a pretty good job. Okay, look at 2018, 2017, not so good. You've got 104 cents going out, 114 cents going out for every dollar. So that's very tough to make money in that environment. There are, as you recall probably from your classes, 2 ways you can make money, even if your combined ratio is in excess of 100. You have your investment earnings, as you recall. So if you can earn 2 or 3% on your investment portfolio, you can use that to offset against these ratios and still continue to make money. Or there could be release of prior year reserves, where an insurance company has set aside assets to support liabilities that didn't turn out to be as onerous as they thought they might be, so they can release those assets and those flow toward the profitability. But in any event, the takeaway here is to think that this industry on a pure underwriting basis has only made a underwriting profit of not that you can count them on 2 hands in the last 60 years. Tough business. Don't believe the hype that the industry is so super profitable. It's tough to make money in this business and do it in the long term. One thing Rodney helped me with these ratios here, it's really important to point out. Look at 2020. All right, you see the 2 numbers there. So one is 110.3. That's the combined ratio that Lloyd's reported. And then to the right, you see one of 97%. And what that is a really good example of is how massive the impact of unforeseen events can be. And this is net of and including COVID-19 losses. So that right there, that's what, 13 points that can be attributed to the effects of COVID-19. So had it not been for that one fortuitous event, the attritional and other losses would have led to a profitable year for Lloyd. So again, that's just kind of drive home. This is the risk in this industry. No one knew that a global pandemic in February, we weren't thinking it was right around the curve, but yet that's what you're here for. You've got to be there to pay the claims when they come due. And that's a good example of what can happen. Let's jump to the next slide because I'm sensitive to time here. I know we want to get to Rod. This is just kind of further teasing out the effect, again, not just of the types of business that COVID impacted, but also the extreme difficulty of trying to quantify what losses might be on something that doesn't have a track history of occurring. We can't model it. I mean, the last global pandemic, what, 1918, so doesn't have a lot of utility. So look at the top line. It says estimated losses as of May 20 of last year, so just about a year ago. And these are in sterling instead of dollars. So the estimate was that the ultimate loss would be between 2.5 and 3.5 billion pounds sterling. Well, the net ultimate losses at 30 June of 2020 came in, it did hit that range right at 3 billion pounds. But look at the development that's occurred since then. The estimated losses in March of this year, so just last month, had mushroomed to 6.2 billion. So right there, it is already up a magnitude of 2 as to what they were previously, and what future development might still occur out of that. So again, it helps accentuate how difficult it is to try and price and understand the impact of these risks. On the left, you see the types of business that are primarily impacted by COVID. Event cancellation makes total sense. You know, Major League Baseball, NBA, Kentucky Derby, all those things, you know, they're canceled. So if you have a policy, it's got to pay out. Trade credit, you know, people aren't out doing business. They're not manufacturing. There's not, you know, food and everything else that's not occurring. So you have implications of credit worthiness and people having to secure those types of exposures. And then, of course, on the geography, the U.S. makes up about 58% of Lloyd's claims there, which seems to follow because Lloyd's is roughly, I think the U.S. is 45 to 50% of Lloyd's global book. So that makes sense as well. So I know I covered a lot of ground in just a couple minutes there, but I want to turn it over to Rod, let him give you a little bit of information about our primary distribution channel here of cover holders in the U.S.
Thank you, Pat. So I'm going to cover the Lloyd's cover holder piece. I am the director based in the Southeast, but I'm also the national practice leader for cover holders. And so let's just jump into cover holders and give you a sense of what a cover holder is and how that kind of plays out for us in the U.S. Mark, if you'll go to the next slide, please. Great. So here's what is a cover holder. So a Lloyd's cover holder is usually the same thing as a managing general agent or a managing general underwriter. You know, for us in the U.S., oftentimes we'll hear MGA or MGU. And so it is somebody that writes on behalf of an insurance carrier. They typically have authority to write on behalf of that carrier. The difference is if you have the ability to write on behalf of a Lloyd's syndicate, you are deemed a cover holder. So cover holder is a term that is strictly for the Lloyd's market. So you may have somebody like an Amwins, a CRC, a Burns and Wilcox. They write on behalf of carriers here in the U.S., but they also have contracts with, you know, folks over in the London market. So they are considered a cover holder as well as an MGA. So that's kind of the difference there is the cover holder term really is specific to the Lloyd's market. So it's a company, or here's the true definition. It's a company or partnership authorized to write contracts of insurance on behalf of the Lloyd's syndicate in accordance with, and that should be the terms of the binding authority. And then finally, each program and capacity is customized to the cover holder. And that's something that's very different where, you know, if you have a domestic contract, oftentimes, let's say AIG is putting out some binding contracts and they want to write a certain type of commercial business, they'll put that contract out to several MGAs and everybody kind of has the same authority, everybody has the same capacity. But with a cover holder agreement, it is customized to you. So it's how you want to write your business, what types of commercial business you want to go after, or what types of homeowners you want to go after. And then that capacity is also customized to you or given to you. So it's a very unique situation versus kind of a standard binding agreement here in the US. Mark, if you move on to the next slide, please. Thank you. So this actually just shows you how the business comes into the US. And so we really have three main channels of business that goes into the Lloyd's marketplace. And this is globally as well as in the US. But when you look at that, the cover holder distribution channel in the US produces about 32% of our business. Non-binder, which we also call open market, produces 56%. The non-binder business would be large, kind of specialized one-off programs. Maybe you have a couple of $1 billion in, insurable values in a public school system or something like that. That wouldn't come through a cover holder because those tend to be smaller, compartmentalized type programs. Where these larger programs, that's where it actually gets to the Lloyd's broker over in London. They meet with the underwriter virtually at this point and actually make that transaction. We used to say face-to-face, and I guess now we can say screen-to-screen is how they do that. So that's how that business comes in. And then we have service company. Just to point that out, a service company is actually a cover holder that is owned by a Lloyd's syndicate. And so there are Lloyd's syndicates that want to write business in the marketplace. Usually it's very specialized, and rather than kind of, push it through a cover holder who might not have the expertise, they keep it in-house and they kind of write it directly here in the US market. So that gives you a sense of how the distribution comes in to the US. Mark, if you'll move on to the next slide, please. Great. So this just kind of shows you, it's a busy slide. Let's just break it down real quick. Left-hand side, you've got the US. As the states get darker, that's how much premium we generate out of those states. So you can see I'm based in Georgia. Georgia is one of those states that generates a whole lot of premium for us. And that's because we have so many E&S carriers, as well as MGAs and MGUs located in the Atlanta area. So it's a real stronghold for that. And so we have a lot of that business coming through. But you can see just kind of how the business flows. We do have a lot, obviously, on the East Coast, and then Texas is one of our larger states, and California as well. Our top 5 states, you can see to the right-hand side there. So California is our largest. Kind of a nice mix of business coming in from that one. When you get to Texas, you see it kind of, the property is a fair amount of it, and then energy is a fair amount as well. But they are doing fairly well with casualty. When you get to New York, it's casualty financial professional. So financial professional is the largest line there. That would be architects and engineers. It's kind of an E&O, D&O product. And then you've got Illinois, and then finally Florida. And you can see Florida is kind of dominated by the property piece of it, which makes sense, right? You've got an East Coast, you've got a West Coast of Florida, highly developed coastlines, lots of insurable value. So property tends to be the largest one for us there. Excuse me, Mark, if you move on, thanks. So this is just showing the cover holder production in the US over a 5-year run, 2016 to 2020. And what you note there is most of what we write is insurance on the cover holder distribution model. A little bit of it is on the reinsurance side. And then finally, when you look at 2019 to 2020, you see a reduction. So about a $600 million reduction in premium that year. We saw a lot of kind of re-underwriting, and what happened was the syndicates kind of took some of that capacity and they moved it over to the open market. So remember, the open market's about 56% of what we do here in the US. And so we actually wrote more on that side in 2020 than we did on the cover holder piece of it. So as a whole, the US increased by 800 million from 2019 to 2020, but we did decline a little bit in our cover holder business. Mark, if we move on to the next slide, please. Great, thanks. So this is really showing you the breakout of how the business comes in by class of business or by line of business. Property is our largest one by far at 3.3 billion, or as Pat likes to say, 300. What was it? 3,000 million. I think was the term. Anyway, then if you look at casualty financial professional and casualty other, both coming in above $1 billion. We are normally considered a property market. When people think of Lloyd's, they say, oh, it's a property market. But at the end of the day, we are very strong as far as casualty other, financial professional, as well as accident and health. So if you add all those together, they almost make up as large a piece as the property side does for us as well. But running down through there, you've got specialty other, which would include cyber. It would also include active assailant or terrorism type coverage. Marine, where we started 300 years ago at about 300 million. Energy at 90 million. So you can just kind of get a sense there of how the business comes in. And this, remember, is the cover holder piece of the business. not the full piece of the business, right? We still have the open market. We still have the service company business that we're not counting in this. Mark, if you'd move on to the next one, please. Great. So as a cover holder, and this is just like Pat was saying with some of the other things, there's a lot of kind of things that benefit the cover holders, just like it is for the syndicates too, right? So the syndicates get the AM Best rating, they get the ability to trade in 200 plus territories and countries. The same thing for the cover holders. There's a whole lot of resources that are out there for a cover holder. And so as a cover holder at Lloyd's, you have all these systems, you have access to ISO wording, you have access to the wording repository that's already been approved by Lloyd's. You have cover holder workbench, which actually is a quote issue bind system that you can take on. So there's just a whole lot of resources that we bring on to help support our cover holders here in the US. Mark, if you'll move on, and I think that's the end of our slides, for me at least. Yes, so this is the last slide for me, but if you have any questions on cover holders, please pop them in the question box. It is, we're a little bit late here, so I know we're gonna have Ian step up and speak for a bit, and then at the end of all of this, we'll have time for questions as well. Thanks so much.
You're on mute, Enya.
Yeah, would you like me to take over now?
I think so.
Welcome, Ian. We were so happy you're here. So the floor is yours.
Thank you, Enya. Yeah, so Ian Bridge, I'm Underwriting Director and Head of Property Insurance at Dow Underwriting Partners, which is a syndicate at Lloyd's. In my role, I've got one of the longest job titles in the world, which annoys me. But you know, the reason for that is I also look at some other areas, or head up some other areas of our business, being contingency, A&H, accident and health business, that is, and property direct and facultative, open market, as was described earlier, and also cover holder business as well. All underwriters specialise. So my particular specialise is property DNF business on an open market basis. And you know, I think I've been asked to talk about kind of impact of COVID on working life a little bit today. And I suppose really the industry that I've worked in for my entire career, which nearly 27 years now, is almost the antithesis of COVID restrictions in some ways, in the fact that the way that we work is that all brokers would come into one building effectively that's operated over 4 floors of trading floors, and actually sit down and within 2 feet of you and talk about an individual risk. And in this day and age, with the COVID restrictions going on, we've very much had to change how we trade at the moment. And so I'm sure you would have seen that Lloyd's has pretty much been closed. The trading room, the building, that is over all of the lockdown, and our lockdown has been relatively extensive in the UK. We're starting to come out of it now, I'm pleased to say, but because we're doing quite well with the vaccine. But and Lloyd's is, I believe, opening a few days a week, and maybe kind of business class restrictive from the 17th of May. So we're all very much looking forward to that. I think what this has done for the industry, though, is kind of kicked us into the future a little bit quicker than perhaps we'd maybe have liked, but I think ultimately it's a good thing, and the reason I think it's overall a good thing is that I think there was a fair amount of resistance when Lloyd's introduced an electronic placing system, for example. It's like nearly 2 years ago now, and what I think most people that you speak to in the industry now would not be able to conduct their job without the electronic placing system. So I think and it has a lot of things going for it. And because the way that we used to transact business is that a broker would turn up to the box, the Lloyd's building. The box is, by the way, I don't know if it was explained earlier because I didn't come on until a bit later, but the box is effectively our trading area. It's just a bank of desks. It's not actually a box, albeit we actually call it the box. And a broker would talk to you about a risk, and generally you'd get the fact that the overall facets of that risk would go away and analyze it and come back, and then they'd talk to you about the slip, the contract, you'd make the necessary changes, then they'd generally result in a third visit where you'd actually commit to that risk by what we call putting the line down. And it's that bit at the end there that has changed with electronic placing. What we've had to do though is amend the first two bits in terms of how we trade. So we've been doing obviously a lot of these type of calls with brokers, which I think works well, but is quite again a very different in a few ways. I mean, you know, the box hours were 11:30 until 1 and generally 2:30 until 4:30, and actually when you kind of look at that as the percentage of your working day, it's relatively low in terms of how many hours that you're actually trading in your full working day. And I think what's going on now is that people are generally underwriting all day, so they're starting their meetings at, you know, generally pretty early and then finishing them generally pretty late. And you know, this is actually the second quarter is our biggest renewal season for property direct and facultative open market business. And you know, it's the second time that we've done this effectively now, so we've got a bit better at it. And you know, but it's definitely very much changed the way that we work in terms of hours, how we do it. But you know, as I said, I think generally it's worked very well. Actually, I think, you know, I did make an analogy a while ago. I think Enya's heard me say this before. As I think you could probably go back as soon as 10 years, and 10 years ago we'd have dealt with this by having a guy in a kind of hazmat suit in our office signing slips for us. And I'm very pleased to say that we've moved on hugely from having to deal with it that way. What some of the challenges that we have with it, you know, certainly this I would say is very relevant to this group. Is that, you know, we are a relationship industry. A lot of business is done with people that you've transacted with for a long time. You build up trust with those people. You go out with those people. You socialise with those people. And obviously, we haven't been able to do any of that. And it's been difficult to bring young people into the industry and get them to meet the people that they need to meet. And you know, and that is why, you know, I'll perhaps touch on this again later, but when you think of the future of Lloyds and the fact that it is a relationship industry, I think there'll always be a point where there's a requirement for people to meet up and have face-to-face transactions and continue to see each other. Whether it will be done in exactly the same way as what it was done before, I'd say that's unlikely. But you know, there is a need for these relationships to continue, and those relationships aren't just with, you know, between brokers and underwriters. They're very much with our retail and wholesale brokers and our cover holders in the US. And you know, obviously we're used to traveling quite a bit. We've not been able to do that, and traveling from the perspective of, you know, generating new business in some instances, but also, you know, on the cover holder side, we quite often used to go and do kind of underwriting audits just to make sure that everything they were doing complied with the contract and was within expectations. And you know, I would say that, I mean, I'd not heard of Zoom before the first lockdown. Obviously, I've very much heard of it now. We're on it today, and I think what's been fantastic about it is that, you know, it's likely, I would say, that we will do less travel in the future, and we'll do a lot more meetings with our US compatriots over Zoom, because it works, and you know, it's been proved that the technology works. And you know, so one example of that would be that we're now setting up quarterly meetings with all our lead cover holders, and I don't think that we would have done that but prior to that, but it's actually been incredibly useful. So I think we've learned a lot of lessons, and I think a lot of things have got better, and I think we'll find a way to work more efficiently and much better in the future as well, actually. But I do think that it will be important for Lloyds to still have a building, albeit I do think that that there'll be the business will probably be transacted in a slightly different way. What I mean by that is that there will be more of these calls going on in the future, I suspect. been asked to talk a little bit about emerging risks as well, which while you're talking about lockdown and as a result of pandemic, it's probably quite a good idea to start with pandemic as an emerging risk. And pandemic is really not an emerging risk, I would say. I mean, it's certainly an emerging risk from the point of view about how big this has been. But pandemic was something that was always very much, and I heard earlier that I'd managed to get on just while you were talking about capital requirements and things like that. And it's been a while now that we've had to calculate and include scenarios for pandemic to calculate our overall capital that we hold at syndicate level to cater for pandemic type events. Now I think you would say with COVID that it's much bigger than what we'd anticipated. And you know that's something that we will definitely be looking at as an industry to perhaps capitalize those events slightly differently in future, because you know you would have seen, I'm sure, from a slide earlier that the impacts of COVID on Lloyds has been huge. And you know, in my world, property D&F, you know, we generally deal with you know, weather events or fire events and things like that. And what we've had here is a loss where there's no physical damage, but there's clearly lots of businesses that aren't able to get revenue either through lockdown or other reasons. And you know that has resulted in some claims in our industry, but for the large part, the D&F market really only responds to losses that are physical damage. And you know, so that one area I said earlier that I'm responsible for is contingency. Well, contingency writes a lot of cancellation type business. So clearly that if you looked into the Lloyd's numbers a lot further, you would see that a lot of the losses are coming from contingency business because events haven't happened. You know, that there haven't been any rock concerts, there haven't been any sports games and things like that where people have been able to attend. So clearly that's a big driver of the loss from that point of view. I think another one I'll mention is claims inflation is a good one to talk about, because I think we've seen that in this pandemic actually, where you know what we've had is a very, very large economic loss, which I think, you know, through certain political pressure there's been on insurers to bridge the gap between economic and insured loss on something like this. And you know that you know, for example, that one example would be in the UK where the FCA brought some test cases to test the wordings themselves, and you know, I would say largely found against insurers and found coverage for insureds on that. And you know, Lloyd's has been very much part of that and been on the front foot of paying those claims where we feel there's coverage. And you know, but there definitely has been some claims inflation on COVID as a result of what I would call political pressure. And that there's quite a few others. I'll maybe just mention a few others that, you know, important ones to me. I suppose social inflation is a big one. You know, we're seeing awards a lot higher on liability claims than what we've seen in the past. And you know, actually that translates itself to some of the losses we see on the property side as well, which is where you've had cat losses, and they're much larger than catastrophe losses, much larger than what we would have expected, and some of that is down to fraudulent activity actually. And you know, it's up to us as an industry to make sure that we're right on top of that, and you know, and that we're managing that risk effectively. But it's certainly one that's very much at the top of our agenda when we're in our board meetings. Other ones I'll mention, ESG. It's less of a environment and social governance, I should say. It's less important in terms of an emerging risk, but it's really important in terms of what we're discussing in our business. So we want to make sure that Lloyds has recently put a statement out about what they're doing on Arctic drilling, coal and oil sands, and they've enveloped that into a group called the Sustainable Underwriting Group. I sit on that group. I sit on our board, our syndicate board, and environmental social governance is something that's really, really important for us these days. We want to make sure that we're good citizens and that we're acting in a good way, and that the business that we do can have as least impact on the environment, and we're supporting climate change in the right way. So that is, as I said, been given such importance by Lloyds that Lloyds have actually formed an LMA group and asked industry heads to be part of it. So a lot of work going on that. Cyber is another one. Cyber has had a number of losses, and the losses seem to be getting worse. They're just, it's a very difficult risk to assess, and it's one of those risks that it is pretty volatile and can be systemic as well. Generally is systemic, and something that we are very much discussing. And in property, we have decided largely to exclude cyber risks, and that's part of the from our own regulator. We were required to do something around cyber risks, and I think what that's done is give rise to a whole cyber insurance market, which is absolutely the right thing to do, because they're the experts and they understand what they're doing, and that they have been providing products. Whereas, I think I said earlier, I really do physical damage to properties. I'm not an expert on how computer systems work. So it's given rise to a whole cyber insurance market, which I think is a good thing. And the only other one I'll mention there really is extreme weather. What we've seen in 2020, I'd love to say was unprecedented. It's really not, actually. It's happened before. But we got to the point where certain, I don't know if you're aware of this, but certain catastrophe numbers are retired, and letters are retired, sorry, I should say, when the loss becomes so big, and we'd actually, when you exhaust A to Z in catastrophe numbers, you move into the Greek alphabet. And we were into the Greek alphabet in 2020 incredibly quickly. I think it was by around September. And certain underwriters like me were very, very concerned that we were going to end up retiring a letter of the Greek alphabet, which wouldn't have made for a very good cat season for us, and is a lot of the driver of. I did actually manage to get on to the presentation earlier, and you saw earlier that that Lloyds was a loss-making business for a few years prior to this, and a lot of that is driven by extreme weather, particularly in 18 and 20. That's all I was gonna say, Enya, and I was gonna kind of leave it for questions now, really. That's okay with you?
That'll be perfect. Let's go open the floor to the audience, to our faculty members and to our students, to see if they have any questions, any comments, any insight to share with us. Love to hear from you. You can either raise your hand, open your microphone, and just speak up.
Yes, I have a quick question. Mr. Bridge, did you say that you do cover cyber insurance risk, right?
No, we in the property open market world, we exclude it. What there is a separate market for cyber coverage that work with their own forms and coverages to specifically cover cyber. Okay, so have you all seen an increased take-up rate of cyber insurance, after, I guess, certain legislation like the General Data Protective Regulations, and, how these companies can be fined huge amounts for data breaches and exposure of PII? Really good question, because the product actually does cover fines for data breaches and such like. So, yeah, and I think, what we do at Lloyds, we have risk codes, as we call it, which basically encompass classes of business, and the risk code for cyber, I think, was created around 5 or 6 years ago. And what you would have seen with that risk code is huge growth since 2014, and that speaks what you've just said there. Is companies, what you've seen is certain markets exclude the risk. So there could have been some coverage in casualty policies in the past. There could have been some coverage in property policies in the past. Those markets have moved towards exclusion. So clients really would be left with no coverage unless they bought a cyber policy. So that's driven some of it. But what you said there is absolutely correct. Is people have realised that the risk of loss is a lot higher.
Right.
And, you see actually some very big limits being bought, Amazon, for example, I know by very large cyber limits.
Okay. Thank you. I have one more question. This is kind of just out to anyone, but I know that Lloyd's is based in the UK, and, it was mentioned earlier that you'll have your own guarantee fund. So I was kind of asking, how does that relate, in regards to TRIA? Is it only, premiums earned that are used for the US market, or is that the company as a whole?
So it's the guarantee fund or the central fund is actually for the market or for the global market as a whole.
Okay.
And it used to be traditionally 0.5% of all the premium that all the syndicates wrote in the year would flow into the central fund. Each year they look at the central fund and see how much it's building up, or if it's been declining because they've made some payouts, and they make adjustments to that. So I know they're below that 0.5% right now, but it is a small fee that comes out of all the gross written premiums that are written. And that is available to any country. So it's anywhere where Lloyd's writes, it's available. We've really not accessed the central fund since, I guess, 2011 was the last time that we accessed the fund. And that was due to the quakes in New Zealand, the quake and tsunami in Japan, the floods in China and Taiwan. So there was a lot that went on that year. And we had a couple of our syndicates that, were kind of out over their skis as far as some of those lines of business in those areas. So they needed some assistance from the central fund.
Great. Thanks so much.
Mm-hmm. And going back to Ben's question about the cyber piece of it, just for context, we have our first quarter numbers in for 2021 here in the US, and just the cover holder piece of it. So not a big piece, I guess 32% of what we write. But our cyber business from first quarter of 2020 to first quarter of 2021 is up 300%. And so we are seeing a huge surge, both in the demand for cyber as well as in the rates for cyber.
I also understand, that y'all were an innovator in, these cyber policies. How has, Lloyd's adopted towards, adapted towards the pandemic and this increase in digitalization? How have the policies changed, I guess, over the past 20 years or so?
So as far as pandemic, and Ian, please jump in anytime you want. So as far as pandemic solutions, there has been some solutions in the marketplace right now, very limited solutions. Again, as the risk is not a new risk, it's evolving, and scope and scale is beyond the commercial insurance market can bear. I think the consensus, if I'm not mistaken, was we really need a partnership between the government and then the insurance sector together, because the overall exposure is beyond any insurance carrier's capacity as far as pandemic exposure is concerned. And Ian, please comment, and Pat and Rod again.
That's a good point. And I guess, Ben, to your earlier point when you referenced TRIA, over the history of that, there's been discussions about renewal of what, as Enya's saying, a government backstop, because some of these exposures are so large, or potentially so large,
right,
you can insure against them alone. So you have that element of government interaction there.
Mm-hmm. Absolutely.
Yeah, I would second that. I mean, the problem that we have, and when you speak to capital is when we're sitting there and we're writing something that's exposed to California earthquake, for example, we can sit there and we can aggregate our risk. the problem here is that it's incredibly difficult to aggregate a risk that is worldwide, and therefore it'd be difficult to know exactly what your downside is, which is a word that we use a lot, and where you're not able to demonstrate or a maximum downside to capital, is that the interest in risk is i.e. because it could go to a point where they lose everything that they've put in, and that's not a risk that they're willing to take. I mean, and that's where I think insurance needs to work with government to provide a solution, as I think mentioned Tria earlier, which is a very good example. There was just a question I noticed on the chat, Enya, which was disentangling claims inflation from social inflation. I'll perhaps take that one quickly. It's social inflation. But when I'm talking about claims inflation, I'm generally talking about things that are not covered, where there's pressure to put in, and or things that where you're seeing certain coverages or certain courts, shall we say, take a different view to the policy language on what is and what isn't covered. So social inflation is something that's generally driven by well, I mean, quite in lots of instances is driven ultimately by fraudulent behaviour. But it's something that we the best example of it was where we had certain lawyers after a cat event. Just basically, going round to people that hadn't had damage in that cat event and saying to them that they would represent them in a claim when they hadn't actually had anything happen, and there wasn't any damage, and then it's very difficult for us to unpick that, and that so those two elements are very different.
Yeah, and the social inflation has become a much bigger issue. Last week, if you keep up with the Insurance Journal, they had National Association of Insurance Commissioners had released a report saying that 76% of all the litigation from homeowners insurance originated in Florida. And so Florida's having a really difficult time with that right now. If you consider that there's a whole, United States out there, and that Florida can generate 76% of all of the national litigation. It's just shocking. So when you get to social inflation, generally, there are some things we can do as an insurance industry, but most of that has to be addressed from a regulatory or legislative standpoint. And so what we'll see there is that eventually, regulators or legislator will start to pass bills that will try to even that out. So social inflation keeps popping up, though. It pops up in different formats. It's one of those things that we always have to be wary for and keep an eye out for.
There's a question regarding Lloyd's stand with medical cannabis in Texas. So that's a great question. Overall, in the US, because at the federal level, cannabis is still illegal, despite the fact we have some states, have more and more states pass the bill to make it legalized. Still at the federal level, that's still illegal. As a result, Lloyd's worst stand is we're not running that at the moment. I believe we're running that in Canada, but we haven't done it in the US in the past few years. And that may change if the federal law changes. With the farm bill recently, I think that was last year, hemp crop has become legalized across the states. So you can write insurance on hemp as a crop. And Ian, again, please jump in if I'm mistaken on that part. At the federal level, still, we're not writing cannabis at the moment in the US.
Yeah, that's absolutely right. Yeah, we're only able to do it where it's legalized at a federal level. Absolutely right.
And to those of you who are interested in looking into more pandemic solutions, we do have a session that I believe Mark just posted the information registration on the chat box. We have a special session called Munich Re Syndicated Box, and they do have a solution on pandemic exposure, which is limited, but it's very interesting. We'll welcome you to join us tomorrow if you have time. Any other questions, comments for us, for Ian, for my teammates?
Enya, where are you based in Texas?
I'm based right outside the airport. It's a small town called South Lake.
Okay. I'm from Houston, so I was just curious.
Wonderful. Where are you based, Ben?
What's that?
Where are you based now?
Oh, I'm currently in Mississippi. I'm a risk management student at Ole Miss here.
Wonderful.
Mhm.
I think we're watching the time. If we have more questions, please just raise your hand and jump in. Love to hear your questions and comments. If not, we're gonna wrap this up because the hour is going by quickly. We're here. Pat is based in Illinois, Kentucky area, and Rodney is in Atlanta, and Ian is in London. And we are all contactable by email, and you can reach out to us if you have any questions. Again, such a great field of career paths. We'd love to see you guys in the future, whether in the brokerage firm, in the carrier side, just this exciting field with a lot of opportunities. We would love to see you guys around and hopefully join this career path and join this business.
Thank you so much.
Thanks everyone for attending. We really appreciate it.
Yeah, it was great. Thank you.
Thank you so much.
Thank you all so much. Special thanks to Ian to join us in London. Thank you for sharing your insight.
And not at all. Thank you. Bye. Cheers, guys.
Cheers. Bye-bye.
Cheers. Bye.
Cheers. Thank you.